Hey, what's going on, guys? Welcome back to my channel. So in this video, I'm going to be fulfilling a subscriber request. This one comes from my buddy Stock Ninja, and he basically said, would love to see some technical analysis on dividend stocks, especially for selling covered calls and cash secured puts. I feel like a lot of us have like 100 shares of a particular dividend stock, and it'd be nice to see some options plays on that. And so what he's referring to is, covered calls and cash secured puts. What this is known as is basically selling premium. Like my other buddy, Dave over at Hidden Freedom Investing he says this is the best kept secret in the financial world. And I totally agree with that. And so I like to think about selling premium in two different ways. One is to basically boost returns with basically no risk. And the other is to use premium as basically income or boosting your income. And so that's two ways, right? Boosting returns and boosting income. And so I am going to make like a series of selling premium. And so in this particular video, we're going to talk about boosting returns on actions that you would be doing anyway, right? And so that's what I'm talking about, free money. And it may sound too good to be true, but I personally don't think it's not too good to be true. I think it's very real, free money that you could be getting that you're missing out on. All right, so first we're going to talk about covered calls because they're a little bit more easy to understand, but you can basically sell a covered call if you have 100 shares of a company. Now, some people may have like 50 or 75 shares of a company and they may add more shares in order to get to the 100 shares. I mean, that's totally viable. Me personally, like if it's not part of your investment strategy, then it's okay to not do it. It's okay to just, get there when you get there. So don't worry. Don't force yourself to get 200 shares just to do this. But yeah, if you have 100 shares of a company, then you are eligible to sell a covered call on it. All right, so and what I pulled up on the screen here is Apple stock, and this is basically the idea of the free money that I'm talking about. So let's say you originally bought Apple with the intention of holding it for at least 3 months, let's say, right? Or maybe even longer than that. But what happened with Apple is it ran up a lot. So, which it actually did, right? So it ran up like, basically doubled in the past 6 months or something like that. So obviously had this huge run up. And so you as a shareholder, you're like, okay, I think Apple is currently worth more than I think it is, and basically it's overvalued and I'd rather take some of that money and put it somewhere else. At the same time, however, you acknowledge that you bought Apple for a reason, right? Because you like the company and you believed it long term. So whether or not you stay with it for the long run or whether you get rid of it maybe 5% where it's currently at, if you're okay with both of those decisions, then selling covered calls is the perfect strategy for you. So let me just go through a more fine-grained example basically. Okay, so let's say Apple, so Apple right now is currently $106 a share, but let's say around this range is where Apple was currently at, right? So right here, Apple's around $110 per share. And you say to yourself, you know what, I think Apple's starting to get pretty overvalued. And as a shareholder, I am starting to get a little bit anxious. Maybe I want to, disperse my money around. And so what you would do is you would basically sell a covered call, and the strike of the covered call would be anywhere from, let's say, 5 to even, let's say, 20% above where it's currently at. And so what does that mean exactly? That means that if you write a strike 10% above the current price and Apple gets to that price, then your shares will get called away. And you say to yourself, well, why would I want to do that? And the reason is because if you were going to sell it anyway, in this particular case, when you sell a covered call, what you get something is cash. You get something called a premium. And so in getting that premium, it's basically like money you can put directly in your pocket. And if Apple gets to that price, which is the strike price, then your shares will get called away, right? But keep in mind, you were going to sell at that price anyway. In this particular case, you're just getting the free money for it. Also, there's a situation in which Apple does not get to that price. It doesn't get to the 10% above the current price like you wrote the strike for. If it just goes sideways, then you keep the premium. And so in both of those situations, you just made money for nothing basically, right? Just for having 100 shares and just for being a savvy investor. All right, so this is the current options chain on Apple. So this is everything expiring September 25th. and that's basically the length of the contract, basically. So after September 25th, it expires, which means it's worthless. And so what we're going to take a look at is what it would be like to actually write a covered call. Okay, so this is the current share price of Apple. As you guys can see, it's worth $106. And so as you go up the options chain, you'll notice that the strike price gets higher and higher. And so this is the price that you're basically making the bet on, so to speak. So if Apple gets to this price, this is the price that your shares will get called away. And if Apple doesn't get to this share price, then you basically keep the entire premium. Now, what is the premium? So if we go to the right here, you can see the price of this contract basically. So let's say Apple is currently at 106 and I say, you know what, if it gets to 110, I'm going to sell this. This is just ridiculous. So what you do, instead of just selling it, or instead of just having an order placed at that price, you can just click on this. And so that's going to activate this options chain. And so this is your total credit, right? So this is what you would be getting. But keep in mind, you're not just getting $1.82 because options contracts happen in hundreds. You would actually be getting $182. So you're getting paid $182 to make that decision to either sell at this price or just keep Apple forever. And so that was basically covered calls. Pretty simple, right? I actually got this idea from another YouTuber named Steven Spicer, so I have to give credit where it's due. But now we're going to talk about selling cash secured puts. And cash secured puts is kind of the opposite in a sense. Instead of requiring 100 shares of a company, you need 100 shares worth of cash for that particular company. So whatever it costs to get 100 shares of a company, you have to have that in cash basically if you want to do this strategy. So what is the use case or idea where you would actually implement this? So you would use this to get free money. Basically, if you have 100 shares worth of cash in your account, and when you say to yourself, okay, I'm looking at Clorox right now, for example, which is on the screen. And so you look at Clorox and you say, you know what, it's gone down a lot. You know, it's gone down like 10% in the past couple of weeks. And you say to yourself, if it goes down another 5%, I'm going to buy it. And basically, if you were going to buy it anyway, right, this is when you would use cash secured puts. So if you're going to buy the company anyway, you would sell a put at the strike price that you want to buy the company. However, you also have to be okay with the fact that the price may never get to that price, right? The price may never get to the strike. And so if that's the case, what happens, you keep the premium. To me, that seems like a win-win. And so this is what Clorox looks like on Robinhood. And so what I'm going to do is go to trade CLX options. I'm going to switch to sell put. And so this would now give us the ability to sell a put. And so Clorox's current share price is at 208.15. And you say to yourself, if it gets to $200, I'm going to buy Clorox, but I'm not going to buy any higher than that, right? Instead of just having an order that will say, okay, I'm going to buy at $200, you're going to sell a put at this price, which will give you, according to this, $60, around $60. And just to summarize, you're getting paid $60 to make that decision, right? Which is, if it gets to this price, then I have to buy 100 shares of Clorox. But if it doesn't get to this price, then I get to keep the premium. But keep in mind, you keep the premium in both of those examples. So in a sense, this is way better than just having an order at $200, right? Because your cost basis actually goes down when you get paid $60 for this decision. And so in both scenarios, whether it's cash secured puts or covered calls, you're basically lowering your cost basis in either scenario, whether you get assigned or whether you keep the premium fully. And so I didn't really get too much into technical analysis. I just kept it kind of simple, and that's okay. Like I said, I might make a series on this. I might make a couple more videos on this because I do have some ideas. But I think that serves as a pretty good intro of when you might use it to basically get free money on decisions that you were going to do anyway. Now, obviously, it comes with a disclaimer, which is having 100 shares of a company or 100 shares worth of cash in the company is actually not the easiest thing to do, right? Most of the times, the really good companies anyway have share prices of minimum like $60, $70, right? But usually it can go up to like $250 or $300, right? So it gets kind of difficult to do it. So this may be something more of an advanced strategy if you guys do have a smaller account. But yeah, I mean, you can always just keep it in the back of your head. You know, once my account gets big enough, I can start doing these cool strategies and yeah, basically get your free money. So that's going to be it for this video. Thank you guys for watching, and I'll see you guys in the next video.